Indian rupee came under sharp pressure today, opening at a record low and for the very first time crossing the 90 mark against the US dollar. The currency began trading at 89.96 in the morning and slipped further to 90.13 soon after. Currency experts say the fall is being driven by persistent foreign portfolio outflows and also growing uncertainty around the stalled India-US trade negotiations, even as the overall dollar index has weakened globally. Market analysts note that the 88.80 to 89 band has now acted as a strong support zone so far. However, they warn that if the RBI eases its defense of the rupee at the 90 level, the currency may slide further, possibly touching 91 in the current cycle. All the eyes are now on the Reserve Bank of India's Monetary Policy Committee, which begins its meeting later today. The interest rate decision will be announced on December 5th. This meeting, in fact, also comes just days before the US Federal Reserve's policy announcement, which is slated to happen on December 10th. My colleague Kartik Malhotra is joining us live straight from the newsroom. Kartik, it is certainly a matter of concern. It is a record low for Indian rupee versus the US dollar. How exactly the markets are going to be affected, and can we see any kind of respite coming soon for us?
Right. So, honestly, the headline seems more scary than the real picture, Sakshi. So, 90 rupee levels is something that markets had been anticipating, and not just markets. In fact, all economists were also betting on, simply because it's gone from, let's say, an 89.89 to a 90.14, while the difference is about just a few paisa. The point is that the sort of, benchmark 90 rupees just sounds a lot more scary than it really is. So, honestly, the RBI is not in any damage control mode, simply put, because the RBI is following what the IMF calls the crawl-like approach, which means that RBI wants to reduce volatility in the currency and not really hammer it down to a certain price point, which is 90 rupees or below. That is not the mandate of the RBI. The idea is to keep the currency price absolutely open and completely in sync with how other currencies in the world are reacting. Now, the weakening of the Indian rupee, which the headline tells us, is actually not as much to do with the rupee depreciation as it is to do with the US dollar appreciation. So what that really means is that there is a larger flow of money going into the US dollar, which is into the greenback, as opposed to money flowing into India. So multiple reasons for that, Sakshi, and one can carry on discussing them. But to begin with, the first reason really is that India's own trade deficit has come in a lot sharper than expected at over $41 billion for the month of October. This means India exported much lesser than India imported. Now, what that really means is that every time you are buying something from another country, you are paying in US dollars. To pay for those US dollars, you are buying the US dollar. And every time there are higher exports, you are getting paid in INR, which means foreign importers are buying the Indian rupee, and hence, the circulation of Indian rupee on the buying side increases globally. So the first factor really for rupee sliding to below 90 rupees has to do with India's trade deficit. So this means India is buying more dollars to settle its claims and settle its import-export decisions, as opposed to foreigners buying Indian rupees to buy more Indian goods. So that is point number one. Point number two is the massive spike that we've seen in gold rates. Remember, India happens to be among the largest buyers of gold, and not just Indian retail consumers. Even RBI continues to buy gold in large quantities, and that is something that even other central banks, including the US, including China, many other large economies also continue to do, to sort of hedge their risk in a volatile trade environment, which has become all the more volatile ever since President Donald Trump assumed office, on the 20th of Jan this year. So high gold prices, India, a net importer of gold, means India is paying US dollars to buy gold. India's trade deficit, which I've spoken about. The third factor really is oil prices. Oil prices are not playing a major role right now because oil prices, global crude prices, have been more or less stable at about $63 per barrel. So that is not something which is getting factored in right now. Now, what this means is that FIIs, FPIs, because you asked the question on markets, they are actually looking more seriously at dollar-denominated, stocks, which happens to be the US. So there's more money going into the US stock markets as money which should come potentially into the Indian stock markets. But with the dollar appreciating and the rupee in comparison depreciating, it means that for every dollar spent by FPIs and FIIs, they'll be able to get technically more shares or more stock ownership for every dollar spent, which means that we might actually see more money coming in future.
Karthik, thank you so much for providing us the detailed explanation of what we should be considering at the moment and what we should be concerned about as well. Right now, we are shifting focus to another big development coming in.